Okay, continuing our discussion now, let's continue to think about our world. It's a perfect market. There's no taxes, no commissions. Securities are fairly priced. So we want to continue our discussion of what happens to the value of companies when we change the debt level that we're currently using to finance operations. So Modigliani-Miller, their second part of their theory here, refers now, instead of looking directly at value, let's look at the cost of capital. So their first proposition basically gives us this relationship between leverage and the equity cost of capital. And essentially it says that equity and debt are equal to assets, and in a world where debt is zero, then U here is the unlevered company, if you will. So the total market value of firm securities is equal to the market value of its assets, whether the firm is levered or unlevered. So V sub L here represents a levered company with debt. V sub U means it's unlevered, no debt. So let's look at the cost of capital, right? What does it cost the company to finance? Well, our simplified equation is how much equity do you have times the cost of equity, plus how much debt do you have times the cost of debt. And again, that equals R sub U, or unlevered debt, or unlevered value of the company, return. So if you solve for R sub E here, what we find out is, if you do enough of the algebra, get it down to its simplest terms, that the equity, the return for the equity of the company is the return if it had no leverage, plus now we have an additional return that comes due to leverage. So again, we're thinking about the return to equity, the return to shareholders. So the levered equity return has this boost, if you will, and this boost, the premium that you get, is measured or altered by how much debt the company has. So the debt to equity ratio is obviously the relationship of leverage. That is multiplied by the difference between the return to the unlevered company minus the return of debt. So again, continuing on with our discussion then. From above, what we find out then is that 15% was the return for the unlevered company. Here's the relationship between debt and equity. Multiply that by the premium, between the return and the risk-free rate. So we end up again with this 25% cost of equity is exactly equal to the return that the equity shareholders were going to receive. So again, we have this equivalence of the cost of financing with the returns that go to investors. So again, this gets a little bit muddy here, but we're just trying to make it one very short little point here, is that the rate of return of an unlevered firm is equal to the rate of return of its assets. So if the firm is then levered, project A is equal to the firm's weighted average cost of capital. That is its required return. That is its cost of financing. Excuse me. So again, if we multiply this out, what we ultimately find out is a company that has no debt, the weighted average cost of capital is just the return of its unlevered company, which again is the return or the cost of its assets. So again, we have created an equivalent argument here that the costs are not changing because of the financing mix. So again, if we have capital markets, the firm's weighted average cost of capital is independent of its capital structure. So, and is equal to its equity cost of capital if it's unlevered, right? And that again matches the cost of capital of its assets. The debt to value ratio here is ultimately the piece that's altering the riskiness, if you will, of the formula. This is how we're prorating, I guess is a good word, of the cost and the returns by the definition or the relationship between debt and value. So what we end up with here, again, is I just want to take a peek at this graph. What we're essentially saying here is in a world with perfect markets, down below here, here's the debt to value ratio going from 0 to 100% debt. We had a company had 15% return cost when it was at 0% debt. The question is, what happens to the costs as we increase debt? And what we find is this weighted average cost of capital is the same. Well, how can that be? We know that the cost of debt is cheaper. So if we're moving to cheaper debt, how can the cost stay the same? Well, the cost stays the same because, as you remember, even if the debt is risk-free, the leverage increases the riskiness and the rate of returns that ultimately goes to the equity shareholders. So these two elements offset each other, so that in the end, the weighted average cost of capital doesn't change. And if we have a situation where the cost of capital is not going to change, that means that the investors are not asking for more money. So with no debt, the weighted average cost of capital is equal to the unlevered equity. As the company borrows, the cost of debt and at the low cost of capital for its debt, equity cost starts to rise because of the riskiness of leverage. So the net effect is that these changes in costs offset each other. So the cost of equity increases, again, to offset the lower cost of financing of debt. So let's take another peek here of how we might be able to explore what happens when we think about perfect capital markets. If we are assumed that the value of the company is the free cash flow of the company divided by the weighted average cost of capital, all we want to do is look at what happens when the company borrows money. So let's assume that nothing happens to the assets of the company. So the free cash flows that are generated, if you remember, free cash flows represent the cash that's been used by all of the decision making of the company. The only thing left is the payment or the cash flow distributions that go to the investors, the creditors, and the owners. So free cash flow is before the decision about borrowing. So how can you increase the value of the company? You can either increase free cash flows, and what we're saying with this analysis is we're just talking about changing debt and equity. So we're going to assume that free cash flows doesn't change. And if it's a perpetuity, if we assume that it goes on forever, this very basic formula says the only way you can increase value is by decreasing the weighted average cost of capital. And in that last slide that we saw, you saw that no matter what happened to debt, there was no change in weighted average cost of capital, so there would be no change in the ultimate value of the company because there's no change in financing or no change in the cost of financing. Now, one of the next steps to start thinking about then is, well, what is happening to risk, right? How is the risk of the company changing? So the effect of leverage can also be looked at, and one of the things we want to do is talk about beta. Everybody understands what beta is, But unlevered beta is the measure of the risk of the firm as if it did not have any leverage, right? So there's no debt. This is a no debt company. So if you're trying to estimate unlevered debt for a project, we need to understand exactly what it is you're trying to measure, right? So if you look at this, the beta of the company is the beta of equity, right? The relationship of that plus the weighted beta of the debt of the company. So if we say that the company has no debt, right, then this is 0, right? This is 1. So the beta of the equity of the company would be of the firm would be exactly equal to the beta of the equity of the company. But as soon as we start adding debt, we then have changes to the overall equity within the company. So we can do a little algebra here, right? How does equity beta, that's the number that's published, how does that change as debt levels change? Well, the beta, the one that's published, represents the unlevered beta, the beta of this company if it had no debt, again, adjusted for the relationship between the beta of, again, the unlevered company minus the beta of its debt, but it's scaled by the debt equity ratio. So leverage in the end amplifies the market risk of the company's assets. That's this beta sub u. So that is what is raising the market market risk of equity itself. So let's think about how we might be able to use this basic relationship, right? So we have CVS, right? They have an equity beta of 0.8 and a debt beta is 0. Suppose that they wanted to increase their borrowing so that their debt equity ratio would change from 0.1 to 0.5. Assuming its debt beta were still 0, what would you expect to happen to the equity beta after we increase the leverage? Well, we can work our way through the formulas, right? So the unlevered beta, the weights times beta equity plus the weights of debt times the beta, and we know that this is 0, right? So we know this is 1 divided by 1 plus debt to equity, right? Times the equity beta, excuse me. So we have 1 divided by 1 plus 0.1 times the equity beta of 0.8. So this 0.73 is now the new beta, right? It's the unlevered equity beta, if you will, of this company. So if you increase leverage, how are we going to deal with that? You take the unlevered beta, 0.73, and now we know that the debt equity ratio changed to 0.5 from 0.1 to 0.5. Multiply by that by the premiums between the unlevered beta and the beta of debt, which we've told is 0. So that tells us that the new beta is going to be 1.9. So thus the equity beta is going to increase with this leverage. So if we can also apply this or put this into a spreadsheet, there is a worksheet that's referred to as asset beta. So in here, if we put in, we have the pure beta play. That's what we're talking about, is the beta of this company is 0.8. You're told that the debt equity ratio was given to you as 0.1 or 10%. So the pure beta play of this company is 0.727. Again, if you remember, it was 0.73. Now, if you plug that in over here to the project's equity beta, in other words, saying like, what happens, in this case, what happens if we change the debt equity ratio? We're going from 0.1 to 0.5. the ultimate project beta or the new beta of this company then is going to be 1.09. So it went from 0.8 to 1.09. So changing the leverage of the company changed the market risk of the company.